In the past, colonial powers asked what they could extract from Africa. China, on the other hand, extracts but also leaves behind skills and infrastructure. Will this change the face of investment landscape in the African continent? Gentlemen, welcome to the program. Thank you so very much for joining us. When you look at Africa, there are many investment options, particularly within the mining space. We know we want exposure to the rising African consumer, but what actual investment options are there right now? Is it private equity? What kind of things are we seeing on the ground, Kobe?
You know, I think that if you look at Africa as an investment destination, the one thing that it can be likened to is maybe the United States, if you look back at 1880 and the 1870s. So the turn of the previous century, so to speak. And I think the thing that kind of comes to mind for me with Africa is that it's a bit of a Wild West type situation at the moment. So certainly there are unitized and liquid type instruments that you could utilize within the African environment, such as funds, for instance, and those are predominantly equity funds. There's some bond funds that you could potentially utilize. And then if you're not going to be doing that, well, you could potentially be buying multinational companies with exposure in Africa. And if you're not going to be doing that, well, potentially you could take direct exposures in Africa. So certainly there's a myriad of options that are open as far as the African landscape is concerned.
Of course, when you look at the risks that are involved in Africa, we know that one of the biggest issues, political risk, that is starting to change. We're seeing far more democratic countries coming to the fore. And growth rates, the largest growth rates that we're seeing globally, in fact, sitting right here on our African continent.
Yeah, it's all about infrastructure and it's all about commodities. And I think China is an importer of commodities, and Africa is an importer of the necessary resources to expand the infrastructure, and that's quite a nice fit. And I guess we've got an expert with us this evening, Alex. Alex, what's your view on the swap trade between commodities and infrastructure?
Yeah, well, most certainly China has certainly got a tape as far as that's concerned. The resources are here in Africa, and there's certainly a lack of every conceivable resource apart from the rare earth metals in China. So China looks around the landscape and finds a lot of the resources over here in Africa, and an abundance of them. The trade at the moment between Africa and China amounts to roughly $120 billion a year, from practically nothing about 10 years ago. Africa is one of the few parts of the world that actually have a current account surplus with China, thanks to the export of all of these resources, most of it unfortunately still in the unbeneficiated state. No sort of value add, iron ore simply exported out and so on. And I think one of the focuses of some African countries is to try to add value to these raw materials that is being exported to China. But at the moment, I suppose lack of expertise in a lot of these areas prevented from doing so. But certainly that is one of the focuses of Africa. And I know our ex-president, Mr. Mbeki, was already talking about that in 2006.
Alex, just something maybe a bit more global on the whole China thing. I'm having a lot of debates with investment strategists at the moment, trying to figure out whether the global growth slowdown that many people are expecting is going to affect China. And the two arguments are that the domestic expansion and investment expenditure in China is going to make up for perhaps the slowing from US and Europe. What's your view on that?
In China itself, or
yeah, internal sort of demand is going to support global demand.
Yes, China certainly has come to the party in terms of consumption. Consumption is still a very low percentage of GDP in China compared to the West. Consumption comprises roughly 35% of GDP, whereas fixed investments is close to 50% of GDP. So when you talk about a possible slowdown in Europe, that is quite likely. I don't quite think that the rising consumption right now can offset the lack of exports that will arise from that out of China to the West. So a meaningful slowdown and a problem in particularly the Eurozone will knock Chinese growth. Having said that, all the research that I've seen is looking for a bit of a slowdown in China from the current 9-10% to roughly 8% or so. I've not yet seen any meaningful forecasts of anywhere below 7% in the next couple of years for China. So we still expect some robust growth out of China. Of course, should China only grow by roughly 5 to 6%, that will be quite a problem for Africa, because most markets are, apart from aluminium at the moment, commodity markets are in shortage. So, you know, if you look at the forecast, some work I've seen from Macquarie, for example, if the rest of the world does not increase its consumption of resources, which, you know, if growth remains flat, and if China continues growing as forecast at roughly 7-8% a year, then we'll find that those markets will still be in shortage and prices will remain high. But should consumption out of China grow by only 2/3 of what it's forecast, then I'm afraid a lot of those markets flip over into surplus, which means that prices will come under pressure. So for Africa, a growth rate in China of 5 to 6% will not be a very good thing. But certainly at the moment, that is not forecast by any credible forecast that I've seen.
Alex, looking at the involvement in China on the African continent, and we're actually looking at the past in terms of how China has been embarking on the mining in the industry there in China itself. You spoke of rare earths. We know that the coal mining industry as well has created quite a bit of environmental devastation within the country, and we know that they're starting to slow that down and source resources from elsewhere. Do you think that Africa should be looking at this scenario introspectively and saying, well, we need these resources to build Africa, and perhaps, yes, we need to export a lot of these resources so that we build economic growth, but we also need to look at what we're going to need down the line and not land up in the same scenario where China has got rare earths that are only going to last them until 2030 or 2040, and this is why they're stopping exporting these very important materials.
Yes, I think obviously, you know, resources, most resources are non-renewable. So I think every country has got to make that decision and look at the equation of what they need now versus what they might need 20, 30 years down the line. I think at the moment, Africa is just not in a position to curtail exports given its needs for possible future shortages down the line. So the necessity of having to export at the moment will prevent Africa from not exporting any of those resources. So it's not at all in the situation that China is with its rare earth metals.
Maybe, Alex, maybe just a question for me. I mean, if you look at Africa as an investment destination, it's fairly tough to invest money at the moment. Like I likened it to the Wild West when I spoke a little bit earlier on. Maybe you can just give us an indication here. Do you think China will change potentially the social and the infrastructural backlog that we're seeing in Africa? And by default, maybe that also changes the investment landscape maybe 20, 30 years hence?
Yes, look, China is already having a notable impact on Africa at the moment. If you go anywhere in sub-Saharan Africa, I mean, you can go to Windhoek. I was there just last month. You can go to Nairobi. Incredible infrastructure being put around the city, and a lot of those projects are Chinese, and they're visibly Chinese, and they're all around you. So most definitely, China is involved in a very visible way in Africa. Will it change the investment landscape? I think it already has. For example, I'm looking at fixed interest opportunities across the African continent at the moment, and most certainly yields have kicked up in line with this incredible risk aversion that we've seen around the world, in line with the inflation. Currencies have weakened quite a bit. And one of the things, though, that fixed interest investors and infrastructure investors want is obviously a return on their investment. They're looking for yield. China comes in with billions of dollars of concessionary loans at very favorable prices. An example is the recent loan that China extended to Ghana. This was debated for a week in the Ghanaian parliament. It extended a loan of effectively, let's call it 3.5% to Ghana, instead of the roughly 6-7% that Ghana could probably borrow from in the open market in dollars. But the condition to that was that 60%, roughly 60% of that money must be used on Chinese contractors. So in a way, China is dictating the game. It's shifting, if you like, contract work towards themselves by furnishing African countries with lower cost of capital. And obviously for someone who wants to go invest and compete with that, it's quite difficult, both on the construction side as well as on the fixed investment side. So you can already see from this example that it's really challenging Western investors and non-Chinese investors who want to do their bit in Africa.
I mean, once you're obviously committed as far as China is concerned into those kind of projects, you're pretty much committed until the end of the project, so to speak. What about fixed income opportunities in Africa that you're looking at? I mean, you're certainly getting yield if you're on a global scale. What about liquidity? Are you seeing a lot of liquidity, like for instance in the fixed income markets, specifically in Africa?
No, liquidity remains a big problem unless it's US dollar debt, where the dollar debt is traded as part of a global dollar index, like, for example, the JP Morgan MB index. Liquidity is very scattered. A lot of the reason for that is that the issues are small, and in order to eliminate rollover risk, a lot of countries issue small issues and they keep on rolling it over. Zambia, for example, being a case in point, where they've got something like 200 bonds. So once you buy a bond, it's pretty much buy and hold markets, and it's only in extremis that a lot of those pension funds, a lot of their holders will sell their debt. So liquidity, I would say, from the point of view of a fixed interest investor in Africa, is the key risk, apart from, of course, default risk, which at the moment is, funnily enough, not as pronounced as in some of those European countries, simply because the debt dynamics are better. Liquidity is a very big risk. So I think if you're going to go into Africa, you have to content yourself that you're in there for the longer haul. And the premium that is there, and it is there to be had for liquidity, is realized over time. So all the fixed interest investors in Africa, one thing that they must be prepared to give up in order to pocket the higher yield is to give up some liquidity and understand that they're in it for a period of at least 3 to 5 years, let's say.
Alex, Kobe alluded to it a bit earlier with regards to how you can get exposure to Africa and some of the companies that operate on the African continent. Would you go via direct bourses such as the Nigerian Stock Exchange? We know the Nairobi Stock Exchange also being relatively popular, the Ghanaian Stock Exchange growing, of course, quite extensively. Would you buy into a multinational fund which has exposure to some African companies? How would one go about it? And some would argue that this isn't really getting exposure into Africa. The way that you actually get exposure is by going and buying a company on a stock exchange on the African continent, as opposed to doing it via a fund here in South Africa, or even an international fund that has exposure to some of the happenings on the continent?
Well, it depends on how sophisticated an investor you are. There certainly are an increasing number of African funds available for the smaller investor to invest in. And, Africa is not a destination. It's not a place. It is 52 countries which have got very different rules, very different tax regimes, very different regulations, different complexity of investment landscape. So I would caution the retail investor from directly trying to deal with those bourses and so on. There are quite a few Africa funds available locally that retail investors can invest in. I would certainly recommend, or if I may advise, not that I may, that retail investors look there. Obviously, for the more sophisticated professional investors, the big fund managers and so on, like ourselves, we would directly invest into those bourses. We would look for companies that are listed on exchanges, and we'd also, in fact, do a lot of investments in the private equity space and in the infrastructure financing space, which is not listed, which is outside of that. And we'd have a look at that those projects on its merits on a case-by-case basis.
Alex, here's a bit of a curveball question. Do you think that Africa is maximizing its bargaining power with China? In other words, is China perhaps holding Africa to ransom, in your opinion, or can we get more out of the deal than we're getting?
Essentially, it depends on the, China likes to deal with the countries where it has got certainty of the political power structure. So very often a lot of these deals are opaque, and whenever there's opacity in any investment situation, it cannot be to the benefit of people outside of the direct negotiation forum. So we would want transparency, and this occurs, I think, in countries which are slowly moving further along the democratic chain. And an example of that occurred in Nigeria, for example. I attended a meeting earlier this year where the Minister of Finance of Nigeria was present, and I asked him about, for example, Chinese labor practices, whether they're bringing their own labor. And he says projects in Nigeria at the moment must at least have 80% local labor content, for example. I think that a lot of the projects that were priced, a couple come to mind in Nigeria as well, by the Chinese for certain infrastructure works were then subsequently valued by other organizations being of much lower worth than they actually were. And with a change of regime in Nigeria, we've had the Chinese having to bid, for example, for oil blocks in China along with everybody else to join the sort of open bidding process. So I think that there is a sophisticated way of dealing and a fair way of dealing with the Chinese. I think they're fair people themselves. They obviously see a good deal when they do. Unfortunately, a lot of countries have got very poor negotiating power. And in those cases, obviously, the stronger player with deep pockets tends to get the better part of the deal. But I think Africa is wising up as to how to deal not only with China, but with the rest of the world. And as we, as a continent, become more and more sophisticated in our business practices, in our awareness, in our democracy, I think that Africa will get much better deals from China and from the rest of the world.
Alex, maybe just a last question from me. I mean, if you look specifically at 2003 and you look at China foreign mining investments globally, you'll see actually quite a few interests across the globe. And when you fast forward that to 2010, you see a lot more interest as far as China mining investments are concerned. Has the structure of these deals changed since 2003, or is it potentially is it still the same?
Well, I think a part of that incredible thrust is simply China's going out into the world. You know, China in the late 70s was apparently isolated, very inward looking, and then looked out. The graph you have there is the past 7 years, and there's been a tremendous amount of growth in the past 7 years in China. The sort of deals that they do are becoming increasingly more sophisticated. I think instead of just wanting to own a whole operation, whole own mine, they're slowly looking at more sophisticated shareholding they're certainly becoming more aware of the environment, I think, slowly at the margin. I think pressures have been brought to bear on Chinese investments in Africa, where instead of denuding a forest or stripping a resource, I think very slowly that whole ecological angle is being taken. And I would say that indeed the nature of Chinese investing will change and will sort of eventually come to best business practice. I don't think it's quite there yet. I think it's still in a funny way for a country like China, which is a country which looks over the very long term. A lot of the projects that they undertake are very short term in nature and do not take the longer term consequences into effect. Yeah. That is slowly changing, but the one thing that is absolutely certain is that if you look at that chart there with all the Chinese investment, if you were to fast forward 5 years from now, there will be far more red dots and far more presence and a far greater presence of China across the world wherever there are resources that they need.
Alex, thank you so very much for joining us. We have to say goodbye to you. We really appreciate your insights. Thank you very much for being with us in today's show. That's Alex Pastana, investment strategist from Sanlam Investment Management. We're taking a very short break, and when we come back, we'll be analyzing the Standard Bank Africa Commodity Index exchange traded notes. Stay tuned.